Well, good morning, everyone. Let me see if I can find where this is. We'll get started here. Looks like folks are still filtering in. So I'm going to be giving a talk today, followed by my counterparts from the Economic Research Service and NAS. And as was just mentioned, I think there are a good number of things we could talk about today. Probably fill the workshop up and spill over into multiple days to talk about big data. And this talk that I'm presenting right now comes from some research that we've been working on with some collaborators, both across USDA and at some of the universities that are represented here in the room, and I'll mention those collaborators when I get to those slides. But this just concerns a question that has come up that I've been asked a couple times over the past few years, which is how does this increased provision of big data and ability to analyze that big data affect, or does it affect, or how does it affect the value of USDA reports that come out, in particular the one that the Office of the Chief Economist coordinates is the World Ag Supply and Demand Estimates. I'm sure that's familiar to many of you, but I'll just touch on what that is briefly and then go into some of the research that we've had to look at answering that question. Of course, big data, as has been mentioned, is a fairly broad topic area, and I'm focusing on one narrow aspect, and we are going to see additional applications. I mean, oftentimes in agriculture we think of big data as sort of precision agriculture amped up, or micro-precision agriculture, so having the ability to be more efficient about input use on fields. Obviously, we also think about how big data could be used by marketing and looking at choices that consumers are making, and I'll obviously mention the last slide or the last picture I've got here on big data when I get it's relevant to some other slides that I've got coming up. So, as I mentioned, this question of what if private companies have access to big data from farms, does that how does that affect what the utility that people get out of USDA estimates? And here's a recent journal article that talks about this, who highlight that there's some notion that at harvest time, real-time yield data could give data aggregators earlier insights on expected harvest yields than are otherwise available. Obviously, the USDA reporting comes out periodically every month, as you all know. Similarly, this article points out real-time harvest data could give an aggregator of a lead of anywhere from days to weeks. And farmers are also concerned about this. A survey done by the American Farm Bureau highlighted some of those concerns, noting that of the producers they surveyed, 66% said big data was extremely important, or it was important that the actual individual operator be able to share in the potential financial benefits of their data beyond the direct value they may realize on their farm. And another 61% of farmers are extremely concerned or concerned that their data could be used by companies or individuals to potentially influence market decisions. So just to get into the presentation, how does big data affect USDA's commodity reporting? I think Renee's going to talk a little bit about this too, but I'm going to focus just on the WSDA here. The WSDA is the World Ag Supply and Demand Estimates, monthly report released by the Office of the Chief Economist, containing official U.S. estimates of world supply and demand for these commodities on a monthly basis. How do we come up with those estimates? Now, we could spend a whole presentation talking about the big data that goes into those estimates, and as I mentioned, I think Renee's going to talk about that some. We get the U.S. world weather and U.S. world estimates from NAS. We get reports from attachés abroad, from the Foreign Ag Service. We have the Economic Research Service, the Agricultural Marketing Service, Farm Service agencies, all coming together to develop these estimates every month. So, for example, right now, one thing that we're following is, obviously, for many of you in the room know, there's a lot of wheat around right now, and obviously the United States is coming off of a record winter wheat harvest. But we also have, last few years, Europe has also had record wheat harvests. And so it's what happens, obviously, in Europe in terms of their harvest affects the prices that our producers are going to receive here in the United States, affects our estimates of what supply and demand will be. And so we use a lot of big data in developing our estimates, and I'm not going to spend a lot of time on this, but just to point out that we do have provision of, and I think some of our other speakers are going to be talking more about this, we use a lot of NASA data as well to look at both temperature, rainfall. We match that up with crop progress, our historic data on how that may look relative to previous years, compare that to satellite imagery, bring all that together along with our expertise about different regions of the world, and develop our estimate of what we think wheat production will be in Europe or the United States or other part of the globe. So we do use a lot of big data in putting this together, but that's not the focus of the talk. The focus is what happens if, is there the potential for the use of more big data in coming up with our estimates, or for a private company to come up with their estimates earlier than we do, earlier than we put out our reporting. So we can think about what types of big data that might be, and I think some of the talks will get into this later today. But we could think about having better data on area planted, and this is just the balance sheet from the most recent WSDA for corn. We could think about having harvester data, whether it's yield monitors, moisture weights, to develop a better estimate of plant health. We could have storage bin monitors, which might give us better information on stocks. Improved data on some of these demand uses, such as improved data for animal rations. Obviously, better estimates of global production or global sales, global use. All of these could, and these are all things that we consider when thinking about ways that we can improve our estimates, but certainly these aren't unique to the United States Department of Agriculture, and other private companies may have access to some of that as well. One thing that we want to sort of judge whether there is this effect occurring, whether our reports are becoming more or less valuable based on big data, is to think about first, well, are they valuable? And this is a report that CFAIR put out. Thanks again to CFAIR for organizing both this report as well as the conference today. But they looked at this and tried to pull together some of the literature that looks at USDA reporting, not just the WSDA, but other reports at USDA. And there are at least a good synthesis of the literature that indicates there are significant benefits. Research at the Economic Research Service also shows how the commodity markets react to the provision of those reports at different times during the year. And this is commodity returns relative to the day that the report was released. And digging into that a little bit more, Mike Ajamian at ERS characterized, using a couple different metrics, what an average report might look like and what a more highly impactful report might be. And that'll, for different crops, that occurs at different times during the year, as you might expect. But nevertheless, just trying to get an idea of, do these reports, does the market react to them? Do stakeholders that are participating in those markets have an effect, see an effect in the market on their positions and their risk management? So the question, again, returning to it, is could private use of big data affect how USDA reporting is valued? For example, could a private company like John Deere or Monsanto access private farm data in real time to affect the market or value of USDA reports? So this is a question that I asked Keith and some collaborators at Mississippi State to look at, and we've been working on a report or some research. It's still in its early phase. We haven't published that yet, and so I'm going to present some of the results here briefly, just to indicate that that's moving forward, and we have seen some interesting things come from that, which essentially just reinforce the notion that how NASS comes up with the U.S. estimates of commodities is the gold standard, the blue ribbon standard for doing this, and other ways of going about this have problems and may lead to unreliable estimates. So just not to dwell on this, because I think Renee may touch on this, but NASS uses an area frame to randomly select, for example, for its corn objective yield, area-weighted samples from across the United States. They take a lot of care and attention in getting an accurate estimate. If you think about, well, how would private companies may go about doing this, we may think that certain farms that sign up to be part of a big data service by a private company may be larger. They may have newer equipment that may bias the estimates. Some of the data arriving from those samples may be limited. For example, you may only have a couple observations from certain important counties or from certain important states. And we might also think about data arriving from those samples from a private company may also be generated at different times during the year based on where they're located. For example, harvest data is likely to start in the south and then move north. So this is comparing the sort of gold standard blue ribbon way of coming up with an estimate to some additional ways that one might think a private company might go about this is the intent of this initial research. So essentially we have a time series of corn yields across the United States on a number of farms, and then we sort of sample it using a couple different methods: random average yield, acre-weighted yield, average yield from just the I states, average yield from the Corn Belt states, average yield stratified by state production, and then similarly, but just from the largest farms in those areas. So we can see that random area-weighted has the least bias associated with it. And this, again, green here is random samples, the red are from the largest samples. So we look at whether you see a change in the estimate when you move from 100 farms to, say, 3,000 farms. Again, and we have random versus the large Corn Belt, random versus the large I state. And I won't dwell too much on this, just to say that, as you would expect, if you're just sampling from the largest farms in Illinois, Iowa, Indiana, you're going to have a higher yield estimate than you would have if you sampled across the United States. Similarly, with precision, if we look at the root mean squared error of those estimates, we see as we sample from more biased samples, we're going to have more uncertainty. One thing we thought about is, well, could these companies are pretty sophisticated. Could they correct for that bias? And we certainly we split the sample in a couple different ways to see whether the bias could be corrected for. And sure enough, you can get rid of a lot of bias if you know what that bias is from a say, for example, say you determine your bias from the first 5 years of a sample, then you can go forward and think about, well, I know that I'm going to be biased upwards. I'll just remove that bias. And moving forward, does that lower my ex post bias estimate? And it does, certainly, for a lot of these. But you still have a difficult time removing that precision. Certainly, as you add more farms, you're going to get a more precise estimate. But it's hard to know, obviously, whether your bias or how to adjust appropriately for uncertain estimates. And lastly, just to point out, we haven't dug into this component all that much, but if you think about a harvest time estimate, getting your estimates first from the southern part of the United States. I can't remember exactly. This is Alabama, Arkansas, Georgia, Louisiana, Mississippi, North Carolina, and South Carolina. Developing your estimates from those states at the beginning of the harvest part of the season, you're going to have a severe bias, both in terms of the estimate, but also fairly imprecise estimate. So the takeaways, at least initially from this foray into this sampling methodology is that big data applications to crop yield estimating at the national level still have some challenges compared to as I mentioned, the NAS standards, which are the blue ribbon standard. Bias correction methods can probably account for certain data limitations, but for others there's quite a bit of variance around the estimate. Of course, and this is just talking about the United States, we're not talking about other parts of the globe, which are also going to affect what a futures price might be in the market. And just to point out that variance that we saw, that precision, that uncertainty around the estimate, while it did get small, the more farms you added and the more spatial variation you had, it was still there. And the question is, well, would a company be willing to go out and make a significant position movement based on that, given that imprecision? And what we've seen recently from some of the markets, very, very small changes in the estimate lead to very large movements in the market. And it's probably fairly unlikely at this point in time that you would get a lot of market traders willing to take a risky position limit based on, given that uncertainty around the estimate. All right, so moving to the next component, the question is, can we see evidence of USDA report valuation being affected by private use of big data? So this is thinking about the question of, if we look at the market, we can see the market. We don't really know what these private companies are doing, but can we see an evidence of them showing up in the marketplace or not? So this is another research project that's been going on by folks at Virginia Tech, University of Illinois, at the USDA Economic Research Service. And I just wanted to point out there's a couple papers that are being presented here at the meetings later. So I'm just going to breeze through these slides pretty quickly, but I would encourage you, for those of you that are interested, to try and catch those presentations later this week. So first, here we show the average impact of USDA reports over the year, and this is for the December corn futures price. The solid line here is the sort of the average additional volatility in the harvest contract price on those report days. And this is taken from 1995 to 2015. So we do see market reaction to different reports in different manners across the year. So what we see is the position or the price in the market change significantly on the day that the report comes, and then it goes back to normal, and then it changes again the next time the report comes out. We see the same thing on volatility. The volatility, the implied volatility of those futures contracts also changes depending on the time that the reports are put out, but certainly there are some that are more important than others. Here, just indicating that is it the October or the November? I think it's the November, or the November report for the corn contract is important, certainly for lowering the volatility on that contract. Soybeans, a little bit different story. Here, obviously, it's a November contract, delivery contract for soybeans, and so the October reporting is more important. So that's sort of our benchmark. Now, what we want to do is split that time series up across across decades to see if private actors that have access to more data and have access to more sophisticated analytical hardware have been able to change their reaction to USDA reports over time. And what we would expect from sort of an efficient market hypothesis is that as, when there is no big data out there and there is no mainframe or desktop computers that are able to crunch that data very quickly on some trader's desktop, the USDA report should be more important because we're providing this unbiased estimate out there to the market where there isn't that information versus a situation where there's freely available perfect information, in which case our report shouldn't have very little effect on the market. So over time, do we see that change? I'm sorry, just to point out. We don't see that, certainly looking at decadal averages, we don't see that happening at all. We see in the most recent decade that the average market reaction, which is the red bars here, versus the non-release days, is actually getting bigger, which is kind of strange. So I'm just going to do, as I've got A couple slides left. I'm going to go through them relatively quickly to leave the other speakers plenty of time to go through their slides and take questions at the end. I think this sums up this component of the research, which shows that over this from 1976 all the way through 2014, the surprise effect, so how the market reacts to these reports, hasn't changed at all, really, which is shocking, I think. You would expect this to trend towards zero, I would think, based on the sufficient market hypothesis. So why is that? Don't know. That's something that we're going to have to keep looking into. And the blue line here is essentially how much the market did react to that surprise. So there is a surprise which is judged by private market forecast relative to the USDA ex post forecast. That hasn't really gotten any better over time, which you would think it would. But ironically, or not ironically, but another odd component of this is that the market reaction has actually gotten bigger in more recent years. It's come back down, but we did see this trend upwards following in the early 2000s, building to like 2010 in terms of the market reaction. So the surprise has not changed, and the market is reacting actually more strongly to that surprise. Here's a couple different ways of looking at it. The same story for soybeans. Obviously, other commodities would be interesting to look at, but no real improvement in the ability of the private sector to estimate what the USDA report's going to be, and similarly, a fairly strong reaction to those as well. Another way of looking at this is we did have this sort of strange natural experiment that occurred in October of 2013. If you recall, that's when the government was shut down. We didn't put the report out. So we look at the market reaction to both in October as well as November. So we didn't put out an October report for corn and soybeans, looking at how the implied volatility changed at the point when you would expect to see that report coming out. Is something else we're looking at. I'm not going to spend a lot of time on this. Again, I encourage you to go and see these talks that are going to be presented by Mike and his collaborators at Virginia Tech during the meetings later at the meetings. Just suffice to say that we would have expected market uncertainty to be lower if the WASDE had been published, and that is confirmed by the results. So we do see some, even though this at this point in time in the production year it wasn't as important just due to other global effects that were going on in the markets at the time. But to conclude, and I thought about these conclusions a lot. They may be overstating what you can take away from these slides. I think we're still at a fairly early point in this type of research, and to try and see essentially the shadow of big data on markets. But certainly we know that big data is already being incorporated into our estimates. And we're going to continue to do that. And as those big data resources become better, we're going to continue to bring those in to improve our estimates. Similarly, we would expect big data to continue to offer technical innovations for improving our forecasts, I just mentioned. We'll hear more today about how producers are likely to use big data to become more efficient on their actual farms. We don't find evidence, right, at least in the way that we've been looking at this, that private sector companies have been using big data in ways to improve their estimate of what our reports are going to say, or improve their estimates of what actual production and therefore the value of futures, commodity futures are. We haven't seen evidence of that yet, though, as I mentioned, we're still looking at that. And lastly, big data currently collected by the private sector does not seem to offer additional value for market positions yet, possibly due to reliability problems. So the question is why, we know that these companies are able to do this. Why are they not? Why isn't that showing up in the market data, at least that we've seen so far? And that's something we're going to continue to examine, perhaps with additional big data on some of those transactions. Anyways, I'll stop there. Thanks very much. Turn it over to my colleagues, and hopefully that got us started.